Oops, I did it again. For the fourth time, I've released equity from one of my properties, this time to the tune of 25 grand. Where should I stick it? This video is about the many different investment opportunities available for such a sum of money. Other people may come into a lump sum and blow it on a holiday, but you know me by now. If I can get even a 10% return on that 25 grand over 20 years, then its future value to me will be nearly 170 grand. I think we can safely say up front that I'm going to reinvest the money.
Ben and I discussed at length where he should be putting this lump sum, and there were only 5 logical options as we saw it. Today we'll talk through the merits of each, discuss the level of risk that Ben should be taking, and whether he should be dumping it all into the market in one go or drip feeding it in. While Ben's £25,000 is this video's case study, we hope that this video also helps to guide you to invest any lump sum of cash that you may come into, and you'll know the investments that are best avoided. Let's check it out. Right now, there are thousands of pounds worth of offers up for grabs on the Money Unshackled offers page, like multiple free shares, discounts on investing information services, and hundreds of pounds of free cash. It's regularly updated, so be sure to check out the new offers we've added for you. Now, let's get into the video.
Where's the 25 grand come from? First up, a quick overview of where the money came from and what I'm trying to achieve. This is not new money being added to my Freedom Fund, but a reallocation of equity from one of my rental properties. The problem with equity which builds up in property is that it has a massive opportunity cost. It just sits there, having almost no effect on the property's future capital growth or rental profits.
The thing to do, if you can, is to release this built-up equity when you remortgage the property and set it to work elsewhere in another investment. This is the before and after position of the property Ben just took equity from. As you can see, the house is worth £150,000 regardless of the equity in the property. If the house appreciates in value to £160,000, Ben would make 10 grand no matter what. That money tied up in the property may as well be busy doing something else. Ben took out the maximum allowed, which in this case was just shy of £25,000, leaving the minimum 25% equity in the property.
My investment requirements. As you may have seen in that last calculation, reducing the property's equity increases the size of the mortgage, and this is costing me an extra £30 a month beyond what I had to pay before. Effectively, a negative 1.5% return. Whatever I invest into just needs to return higher than this for me to be in profit. Beyond this fairly easy goal of beating 1.5%, what I really want is for my investments to return in excess of 10%, preferably closer to the 25% return I've been getting on that initial property investment. Invested wisely, it can hopefully knock years off my working life.
Then there's how much risk you should be taking. Generally, the younger you are, the more risk you can take. There are some schools of thought that you can also take more risk if you have a higher job income. While we think this is true, we also think that those on a lower income often have to take on more risk to compensate for their smaller contributions if they are ever going to build up a large investment pot.
That said, I won't be investing my lump sum into crypto. I may as well consult the crystal ball for an idea of which direction the crypto market is going to move long term. Maybe it's worth a small dabble, but moving my precious lump sum of property equity, built up over years, into something as wild as crypto, it's not for me.
Option number 1, leaving it in cash. Ben and I have been talking a lot about business opportunities lately, and having a sizable lump sum of cash on hand creates opportunities to start up a business or invest in yourself. For you, the cash might be a means of changing career or putting yourself through higher education. Not every investment has to be in the markets, but keeping such a large amount in cash worries Ben, as he has to cover that £30 a month cost of holding the money. Plus, of course, inflation is forecast to hit 10%, making the holding of excess cash a short-term option only.
Option number 2, another property. This is the most obvious choice. I took money out of a property, so I should probably put it towards buying another one. Indeed, that is what most property investors do when they release equity, and is how I've already grown my portfolio to include 4 rentals. But I said in this video that I'd like to diversify my total portfolio away from property. 70% of my wealth was in 4 rental properties, at a time when property looks to be losing some, but by no means all of its shine as an investment class.
Increasing regulation, increasing interest rates, and stagnating salaries of tenants are all worries for landlords right now, and while the big returns are still there, it might be wise not to have all your eggs in one basket. Ben's current goal is to have property be no more than about 50% of his total portfolio. If you're not there yet yourself and you're interested in investing in buy-to-let properties the Money Unshackled way, check out our Find Me a Property service. We'll put you in touch with our approved property agent who will get you set up with your first buy-to-let property or even source you a whole portfolio of them. And check out this video next for an idea of the expected returns.
I think I'm right to own a number of properties, and for my wealth of 300 grand, owning 4 mortgaged properties seems about right, if not a little high. While the returns are incredible, they say diversification is the only free lunch in investing, and it might be wise to look elsewhere for my next big purchase.
Option number 3, self-invested personal pension. A SIP is a personal pension that you manage yourself. Ben and I both have our pension money in SIPs because we like to take personal control over our futures, but you could just deposit a lump sum in your workplace pension instead. While a sensible option because it involves long-term investing, I could come up with 2 solid reasons for Ben not to invest his lump sum into his SIP right now. Firstly, while you do get tax relief of 20%, 40% or 45% depending on your tax bracket, there's often no rush to do this. There are complex rules around this, but you can backdate pension contributions for up to 3 years. Ben could reallocate his money into a SIP sometime in the future instead. And secondly, that money is locked away until your late 50s at the earliest, and Ben might hope to retire before then, the way he's going.
If you're a higher rate taxpayer and intend to work until at least your late 50s, then a SIP might actually be the number one choice for you. You'd get 40% tax relief, turning a lump sum of 25 grand into a lump sum of 42 grand. Freetrade has a very competitively priced SIP with an investment range of thousands of stocks and ETFs. Check them out, and if you decide they're for you, you'll get a free stock when you open an account via the link on the Money Unshackled offers page.
Option number 4, the Money Unshackled Ultimate Portfolio via a Stockton Shares ISA. We believe this is one of the best options for most people aiming for early retirement. Here is the Ultimate Portfolio in Ben's ISA on Invest Engine, the cheapest place we've found to invest in all 5 of these funds.
This was a serious contender for my lump sum, though I could only have deposited 20 grand into my ISA due to the annual ISA allowance. We cover in this video the contents of the Money Unshackled Ultimate Portfolio, why we believe it is the best possible stock market portfolio to own, and how to invest in it without trading or platform fees.
Option number 5, leveraging the S&P 500. This is what Ben actually did. One of our prouder achievements is the creation of the Money Unshackled spread betting portfolio, which invests in a combination of S&P 500, long-term US Treasury bond and gold futures via a spread betting platform. Sounds complicated? It is.
Our analysis showed that over the last 43 years of available history, a 60-30-10 mix of these 3 indexes provides the best returns for a given level of risk when leverage is applied. I will be investing 27 grand into this portfolio, which is my lump sum plus some other excess cash, and at least initially I will be using 3 times leverage. This is not a strategy for noobs, and most people would be advised to stay away and maybe stick to option number 4 instead, investing in something like the Ultimate Portfolio through an ISA.
As Andrew Craig says in his groundbreaking book, How to Own the World, if you do spend the time to learn how spread betting works, it is one of the most powerful tools for making money available today. But between 80 and 90% of people who spread bet lose money. If you are going to use this kind of account, it is crucial that you learn enough to put yourself in that top percentage of people who don't.
Having previously played around with a little over 3 grand invested in the portfolio, I'm using my new lump sum to take a serious position. At 3 times leverage, 27 grand would give me exposure to an equivalent portfolio worth 81 grand, on top of what I've already got, and hopefully some serious returns over the long term. Though it may be sensible to reduce my leverage to 2.5 times, or even 2 times, as the pot grows in size and importance. This changes my total portfolio weightings so that I now have a 59% allocation to investment property, down from 70%, while retaining the leverage that both property and spread betting affords.
Drip feed or all at once? The main reason to drip feed is to avoid the psychological blow of a market downturn happening in the days and weeks after you've just put everything into the market at a high. But the maths is on the side of investing a lump sum all at once. The basic logic is that on average, the market goes up more often than it goes down, so having all your money in the market from day one is likely to do better than having a load of it in cash while you slowly drip it in. Later purchases are more likely to be at higher prices than the initial deposit. Drip feeding a lump sum is a type of trying to time the market.
In a research paper by Morningstar looking back as far as 1926, over the average 10-year time frame, 9 out of 10 times an investor who dripped money into the market would have ended up with less money than if they had simply put all their money into the markets at the beginning. Shorter time frames of drip feeding are better, with a 37% chance of doing better than lump sum investing if you only drip fed over 2 months, with your odds dropping sharply thereafter. Apologies, by the way, for the resolution of these images.
These next two charts show that even just before significant market crashes, dumping in a lump sum all at once would have given you better returns. Blue is a 60-40 stocks to bonds portfolio and red is the S&P 500. The important place to look is the darker LSI lines, which are lump sums invested all at once, while the lighter DCA lines are the drip-fed portfolios. The first chart looks at the 2009 financial crisis starting just before, and the second chart starts during the 1970s market doldrums. It seems that by drip feeding, the risk is that you are far more likely to make lower returns.
But there are other reasons to be cautious about going all in. For one, leverage is not factored into these statistics, and we're only assuming it would give a similar result. And as we've said, having cash in the bank for longer opens up other opportunities for alternative uses. Taking encouragement from both stocks and bonds being at recent lows, the S&P 500 was down 13% from its all-time high. I decided to put a third of my lump sum immediately into the markets, £9,000.
Ben will drip feed in the rest, if only for psychological reasons, because it's such a lot of money to put into a relatively new investment strategy all at once, but he's thinking of dripping it in over a short time frame of perhaps 6 months. What would you do in his shoes?
Question of the day: how would you invest a lump sum? Join the conversation in the comments below.
Thanks for watching! On this channel we talk a lot about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.